The US stock market has reached another important moment. The S&P 500 is sitting near record highs. The Nasdaq remains extremely strong. Technology and artificial intelligence continue to attract massive investor attention. Corporate earnings have been supporting the market, and concerns about an immediate Federal Reserve rate hike have recently eased. On the surface, this looks like an almost perfect environment for stocks, but there is something investors need to understand. When the market reaches record highs, the biggest question is no longer simply whether stocks can go higher. The bigger question becomes whether the economy and corporate earnings can continue supporting those valuations. And right now, Wall Street is facing several important tests: inflation, interest rates, consumer spending, corporate earnings, oil prices, Federal Reserve policy, and the enormous expectations surrounding artificial intelligence. The S&P 500 recently closed at a record 7,798.99, gaining 0.65% on August 13th. The Nasdaq also reached a new high, while the Dow moved closer to its own record. That is a powerful signal of investor confidence, but it also means investors are becoming increasingly sensitive to anything that could change the current story. One of the biggest reasons stocks have been strong is inflation. For months, investors have been watching inflation because it directly influences what the Federal Reserve does with interest rates. If inflation remains high, the Fed has fewer reasons to cut rates. If inflation continues cooling, policymakers have more flexibility. And recently, several inflation indicators have provided some relief. July consumer inflation came in without a major upside surprise, while producer prices showed no monthly increase in July. That helped reduce concerns about an immediate rate increase. The result was a positive reaction across financial markets. Treasury yields moved lower, technology stocks gained, semiconductor companies strengthened, and investors became more confident that the Federal Reserve may not need to tighten monetary policy immediately. That is important because interest rates have a huge influence on stock valuations. When interest rates are high, investors have more alternatives. They can hold government bonds and potentially earn attractive yields without taking the same level of risk associated with stocks. But when investors expect rates to fall, stocks can become more attractive. This is particularly important for growth companies. Technology companies often have valuations based heavily on expectations for future earnings. When interest rates decline, the value investors place on those future earnings can become more attractive. That is one reason technology stocks can react strongly to changes in Federal Reserve expectations. But there is another side to the story. The Fed still has a problem. Inflation has improved, but it has not completely disappeared. And policymakers need to be confident that inflation is moving sustainably toward their long-term goal. That means one good inflation report is not enough. Investors need a trend. They need to see several reports showing continued improvement, and that is why the next few months could be extremely important. Now, there is another major issue developing: the American consumer. Retail sales unexpectedly declined in July. That has created a completely different question for investors. Is the U.S. consumer beginning to slow down? Consumer spending is one of the most important engines of the American economy. When people spend money, businesses generate revenue. When businesses generate revenue, they can hire workers, invest in expansion, and produce profits. Those profits are ultimately what supports stock valuations. So a sustained decline in consumer spending could become a serious issue. But there is an interesting twist. A weaker consumer can also reduce inflation. When consumers become more cautious, businesses may have less ability to raise prices. That can reduce price pressure. And if inflation falls, the Federal Reserve may have more room to ease monetary policy. That is why investors are currently trying to determine whether weaker retail sales are a warning sign or part of a potential soft landing. A soft landing would mean the economy slows enough to reduce inflation without falling into a severe recession. That would be an ideal situation for the stock market. Imagine inflation continues moving lower. Interest rates eventually decline. Consumers remain reasonably healthy. Corporate earnings remain strong. AI investment continues. And unemployment does not rise sharply. That combination could support the current market rally. But there is another possibility. Consumer spending could weaken further. Companies could see slower revenue growth. Hiring could slow. Corporate profits could decline, and the economy could move toward recession. In that situation, lower interest rates would not necessarily be enough to keep stocks rising, because investors would be worried about earnings. This is one of the biggest lessons investors need to understand. Interest rates matter, but earnings matter too. A company can benefit from lower rates, but if its revenue and profits are collapsing, investors may still sell the stock. That is why the current earnings season is so important. Corporate earnings have been one of the strongest supports for the stock market. Technology companies have continued reporting strong results. AI infrastructure companies have attracted huge amounts of investor interest. Semiconductor companies have benefited from strong demand, and companies connected to data centers and computing infrastructure are becoming increasingly important to the market. Recent trading showed exactly how powerful this theme has become. Strong earnings from AI infrastructure companies helped push the S&P 500 and Nasdaq higher. CoreWeave jumped sharply after raising its capital spending outlook and reporting stronger than expected results. Super Microcomputer also gained after giving investors a stronger revenue outlook. NVIDIA and Micron benefited from the broader semiconductor rally. This tells us something important. AI is not just a technology story anymore. It is a market story. It is an earnings story. It is an investment story. And increasingly, it is also an economic story. Companies are spending enormous amounts of money on data centers, chips, networking equipment, and electricity infrastructure. That spending creates revenue for other companies. Those companies hire workers, they purchase equipment, they build facilities, they consume electricity. And all of that economic activity can influence the broader economy. This is one reason investors remain so optimistic about AI. But high expectations also create risk. When investors expect extraordinary growth, companies need to keep delivering extraordinary results. If a company reports strong growth but not as much growth as investors expected, the stock can fall. That has already happened with several AI-related companies. A strong business does not automatically mean a strong stock. The price investors pay matters, and expectations matter. This is particularly important when major indexes are near record highs. At elevated market levels, investors have already priced in a lot of good news. That means future earnings need to justify those expectations. This is why the next stage of the market could become more complicated. The first phase of the AI rally was largely about potential. The next phase is increasingly about proof. Can AI actually generate enough revenue? Can companies earn attractive returns on their enormous investments? Can AI improve productivity? Can those productivity gains eventually reduce costs? And can the AI boom continue without creating inflationary pressure that forces the Federal Reserve to keep rates higher? Those questions are becoming more important, and they are directly connected to the stock market. Now let's talk about the Federal Reserve. The Fed held interest rates steady at its July meeting. Markets are now waiting for the minutes from that meeting, which are scheduled for release on August 19th. Investors will be looking for clues about how policymakers view inflation, economic growth, and future interest rate decisions. This could be extremely important. Why? Because markets are driven by expectations. If investors believe the Fed is becoming more comfortable with lower inflation, stocks could benefit. If investors believe policymakers remain extremely concerned about inflation, Treasury yields could rise and stock valuations could face pressure. The market is constantly trying to predict the next move. And right now, traders have reduced expectations for an immediate rate hike. Reuters reported that after weak retail sales and declining consumer sentiment, traders reduced the probability assigned to a September rate hike to around 30% from roughly 50% a week earlier. That is a major change in expectations. But expectations can change again. If future inflation data surprises higher, traders could quickly rethink their outlook. If inflation continues cooling, expectations could move in the opposite direction. That is why the market may remain sensitive to every major economic report. Now let's consider Treasury yields. Treasury yields are one of the most important indicators for investors to watch. When yields rise significantly, borrowing costs can remain elevated. Higher yields can also make bonds more attractive compared with stocks. And when yields decline, financial conditions can become easier. Recently, Treasury yields have moved lower as concerns about an immediate Fed rate hike have eased. That has been supportive for stocks. But investors need to understand why yields are moving. If yields decline because inflation is cooling and the Fed may eventually ease policy, that can be positive. But if yields decline because investors suddenly become very worried about economic growth, the situation is different. Again, context matters. The same market move can have completely different meanings depending on the reason behind it. Now let's talk about oil. Oil prices have become another major variable for the U.S. economy. Energy prices influence inflation. When oil prices rise, gasoline prices can rise, transportation costs can increase, businesses can face higher operating expenses, and those costs can eventually move through the economy. Recent geopolitical tensions involving the Middle East and the Strait of Hormuz have kept oil markets volatile. That creates another risk for investors. Imagine inflation is finally beginning to cool. Then oil prices suddenly surge. The improvement in inflation could slow. The Federal Reserve could become more cautious. And investors could begin adjusting their expectations again. This is why the market cannot focus only on technology and AI. There are multiple forces affecting the U.S. economy. Now let's look at consumer spending again. The latest retail sales data showed unexpected weakness. That could indicate households are becoming more careful. Perhaps high prices are still affecting purchasing decisions. Perhaps borrowing costs remain restrictive. Perhaps consumers are becoming more uncertain about the economy. Or perhaps the decline is temporary. The next few months of data will help answer that question. And major retailers could provide some of the best clues. Companies such as Walmart, Target, and Home Depot are closely watched because their earnings can provide a window into consumer behavior. Investors want to know what consumers are buying. They want to know whether customers are trading down to cheaper products. They want to know whether discretionary spending is weakening. And they want to know whether businesses are seeing stronger or weaker demand. Recent reporting has highlighted the importance of upcoming retail earnings as investors try to understand the health of the American consumer. This could become one of the most important themes for the next phase of the stock market, because the consumer and the stock market are connected. If consumers remain strong, corporate revenues can remain strong. If consumers weaken dramatically, earnings could eventually feel the pressure. But there is another factor. Higher income households may behave differently from lower income households. Some households have large investment portfolios. When stocks rise, their wealth increases. That can support spending. This creates what economists call a wealth effect. When people feel wealthier, they may become more comfortable spending. That spending can support the economy, but it can also create additional demand. And additional demand can influence inflation. So even the stock market rally itself can become part of the economic story. This is one reason policymakers pay attention to financial conditions. The stock market is not isolated from the economy. It can influence consumer confidence and spending. Now let's think about what could happen if the current rally continues. If inflation continues cooling, investors may become increasingly confident that the Fed can eventually reduce rates. If corporate earnings remain strong, stocks could continue to receive fundamental support. If AI investment continues growing, technology and infrastructure companies could remain market leaders. And if consumers remain reasonably healthy, recession fears could stay under control. That would be a very bullish combination. But markets do not move higher simply because the story sounds good. Investors need confirmation, they need data, they need earnings, they need guidance from companies, and they need the Federal Reserve to avoid becoming more restrictive. That is why the next several weeks could be so important. Now imagine the opposite. Inflation starts rising again. Oil prices move sharply higher. The Fed becomes more concerned. Treasury yields rise. Consumer spending weakens. Corporate earnings disappoint. That combination could put significant pressure on stocks. Again, this is not a prediction. It is simply a scenario investors need to understand. Markets are about probabilities. Nobody knows exactly what will happen. The goal is to understand the forces that could move prices. And right now, the biggest forces are clear. Interest rates, inflation, earnings, consumer spending, AI, energy, and Federal Reserve policy. Let's talk about valuations. This may be one of the most important issues that receives less attention during a strong rally. When stocks are near record highs, investors should ask how much future zero among policymakers. And if those minutes reveal strong concern about inflation, investors could react. If they reveal greater concern about economic weakness, investors could interpret that differently. The market will be reading between the lines. That is what markets do. Investors are constantly trying to understand what today's information means for tomorrow. Now let's imagine a best